President CEO of Old National Bancorp, Bob Jones. Bob has been at Old National since 2004. Previously, you were a veteran of KeyBank. You also serve on the Federal Reserve Bank of St. Louis Board of Directors, where you're a member of the Executive Committee. You're also on the board of University of Evansville Regional Business Council, Vectren Corporation, the Economic Development Coalition of Southwest Indiana, Riley Children's Hospital, and Youth Resources of Southwestern Indiana. Bob, we're delighted to have you here today.
Great, thanks. Good to be with you.
First question. I understand that Old National had some challenges in the early 2000s with some of the expansion that was done in places like Indianapolis and so on. What happened there, and what have you learned from that experience?
I'll give you a perspective. I was not here during that time, but my sense is, John, as a company, we kind of forgot our history, forgot our tradition, and we became convinced that in order to earn our independence, we had to grow at rates that far exceeded the rates of growth in our markets. And at the same time, we consolidated all of our back rooms and our operations and our charters, thus giving us much larger capacity to lend, but we didn't really change the processes. So we were still acting like a small community bank in our markets, but yet we had the capacity to be a much larger bank. And without the right controls and risk mitigants in place, it can become a recipe for disaster, and unfortunately it did create some real challenges for the company. So I think the lesson learned is, one, banking is not and never was intended to be a growth business. It is really intended to grow. A successful bank should grow slightly above the markets they're residing in. And secondly is that banking is really all about managing risk, and at the end of the day, a good bank, a strong bank, is a bank that knows how to manage risk and take the appropriate amount of risk, but reward their shareholders through that management of risk.
Great. On that same topic, I was impressed by the honesty you had shown in the American Banker story about a month ago, where you talked a little bit about how there were some slip-ups with integrating banks, specifically losing the lending team at Tower Financial to a competitor. What was the takeaway from that experience?
Well, that I screwed up, quite frankly. It's one of the challenges in M&A is that you work so hard to get to the altar, then you work hard to put the ring on your partner, and as in your own marriage, you got to continue to do these little things. And I think the lesson I learned, John, was that I failed to continue to do the appropriate relationship building post-marriage, and by virtue of that, we didn't do a good job of onboarding some folks, and they saw a better partner, and they made the best choice for them. So I think the lesson I've learned is to continue to be engaged and continue to do the things you do prior to the announcement of your partnership.
Sure. I noticed your recent acquisition of LSB Financial is putting you pretty close to hitting the $10 billion threshold. I think you did the first quarter.
Yeah, we'll actually be at $11.5 billion pro forma with that acquisition.
Okay, you'll be at, I'm sorry, at 11.5?
Right. Yep.
And what are some of the issues and opportunities with crossing that threshold, and how are you adjusting to the increased regulatory scrutiny,
Sure.
additional costs that come along with
a lot of it, I'll give the regulators credit. As they saw us moving on a path to get above $10 billion, they were very direct in saying, here's what you're going to need to do. We think you need to do it sooner than later. So as you think about what comes with getting across that $10 billion mark, there's a number of things you've got to be aware of. You've got a new regulator in the CFPB. You've got to do stress testing on your balance sheet. You've got some requirements on capital that are slightly different. And all of those, our primary regulator, the OCC, said, we think you ought to start doing that sooner than later. So, again, one of the requirements is a board-level risk committee. We've got that. We've had that in place for years. Independence of your chief risk officer. We changed her reporting relationship to having an independent reporting to the board, not to management. We've prepared a book that says, here's what we have to do for the CFPB. We've got our asset-based scorecard for the FDIC, and we've begun the process of stress testing. So, again, by virtue of their good coaching, we had 4 of the major 5 elements of being above $10 billion in place. The obvious one that's not there is the Durbin Amendment, and that's just one that, because you get bigger, you've got to have a reduction in your interchange fee, and we identified early on what that cost would be, and then as we cross the threshold, we try to mitigate that as best as possible. That you can't completely mitigate the fact that you have a reduced interchange fee.
Yeah, I was looking at the, so you must have crossed it in the second quarter, because at the end of the first quarter you're at 9 point.
Yeah, we closed. We have the UBT, which will close in a couple of weeks, the bank in Ann Arbor, and then Tower closed post first quarter. So both of those would be pro forma.
And I've noticed, just from observing the bank, that you've done very strongly in the more secondary and tertiary markets, and have typically not been one of the largest banks in the Indianapolises and Louisvilles of the world. Any thoughts on that secondary and tertiary strategy?
Yeah, very perceptive. Actually, we like what use your definition of what we call as mid-sized markets. Here's the really large banks do not go to those markets, and if they do, they don't really execute well in those markets. So we can go to a market like Bloomington, Indiana, or Columbus, Indiana, or Evansville, Indiana, or Fort Wayne, or Kalamazoo, where our model works very well. It's a community-based model. It's really dependent upon a brand that is about our commitment to the community, and actually make better spread and get comparable volumes versus going to a Chicago or a Cleveland and competing with everybody, getting very reduced spread, and potentially doing either structural or risk elements that we're not comfortable with. You mentioned 2 markets that we have a presence in. Indianapolis is a very competitive market. It happens to be the capital of our home state, and we're the largest bank headquartered here in Indiana. So we are in the Indianapolis market. We'd like to be bigger there, but we've really taken a niche strategy, which is to focus on kind of the higher-end small business and our insurance business, and it's worked very well for us. Louisville, quite frankly, we'd aspire to be a little larger because we think Louisville looks a lot like Indianapolis. It's competitive, but not as hyper-competitive as some of the other markets. But, at the end of the day, our strategy is designed around providing the greatest value to our shareholders, and we think we can do that better in those mid-sized markets.
Sure. I did notice that in your major lending categories, there was a pretty significant spike in indirect lending. It looked like it jumped 30% in 2013 versus 2012. What's going on over there?
Well, a couple things. I think one is our entry into the Michigan market. As we entered Michigan and Kalamazoo and parts there, we found a very receptive market for indirect lending, and we've had great success there. And it kind of goes to that mid-sized market, whereas a lot of the larger banks focus in Detroit and Grand Rapids. We've had great success in that southern tier in the Michigan market, so it's worked well for us. The other part is that I think it's reflective of the economy in Indiana and where we're based. Very strong economy. I think the consumer feels a lot better. And as you well know, prior to 2013, I think the average age of a car was 11 and a half years. So all of our dealers have seen great volume increases.
Sure. How did you get into banking?
Yeah. I started to laugh. I got married. I needed to make money, and I was going to law school at night. And I said, well, I'll go into this banking thing until I graduate from law school, or I really don't enjoy it. And 35 years later, I'm still in banking, and I didn't complete my law degree. So it's a great example of pure luck or happenstance or a hobby that became reality. I'm not sure what it is, but I was a political science major in college and had always intended to be a lawyer, and I got into banking as a teller and management associate, but a teller, and just really enjoyed the customer part, and then the fact that, you know, there's so many facets and aspects of banking that you can learn from and grow. So it's been good.
When you go from a key bank, which is a too big to fail size institution, to a super community bank like an Old National, what are some of the contrasts, pluses and minuses of the different size banks?
You know, Old National is a simpler institution. It's, you know, we're a fairly basic institution. Key was a very complex, excellent company, but, you know, we had banking, we had investment banking, we had capital markets, we had real estate, you know, very complex. So I think, you know, I've kind of described it as kind of back to the future, John. So I've gone back to where, when I started Key, we were a $500 million bank in Cleveland, Ohio. And, you know, when I left, we were $80 billion in 13 states. And what I really enjoy about what I do is that it is simpler. I know most of the people that work here. And we can make a difference in our communities because, again, those mid-markets, there's things we can do as an institution that really impact the economic vitality and social vitality of our markets. And quite frankly, that's what gets me going in the day, is that, you know, if we can do something that makes a difference to our communities, which, you know, quite frankly, I believe is our moral responsibility as an institution, it's rewarding.
Is there a competitor that you most admire, and why, I would ask?
You know, that's a great question. So I'm a big fan in the Midwest. I'll talk for a second. I think what Steve Steinauer is doing at Huntington is very, very good. I think Steve has really come up with a strategy that's kind of counter to most institutions, and I think he runs an outstanding bank. I think they do a great job. I think PNC is an outstanding super regional or, you know, too big to fail bank. I think they run a fairly traditional bank, but I think their execution is outstanding. I'm still a big fan of Key. As Kathy can well attest, I live in Indiana. I'm very loyal to the markets, but I'm a Buckeye at heart, and you know, my home state still means a lot to me.
Sure, sure. Switching over to the M&A side, we did touch a little bit on some of the markets you've gone into, but what markets are most attractive to you right now as far as future M&A, and why?
Well, again, I think it goes back to those mid-sized markets. So if you think of where we have gaps today in our defined territory, which would be Indiana, Kentucky, Michigan, you know, I'd like to be bigger in Louisville, obviously, as I said, but you think about a Grand Rapids. I think Grand Rapids is one of the, you know, most dynamic markets in the Midwest. You know, we've entered Fort Wayne, we're entered in Ann Arbor, we've got into Lafayette. I'd like to be bigger in the northern part, Warsaw, South Bend. You know, I could be bigger in. You know, so again, you think about those mid-sized markets. You know, Lansing, Michigan is another one that we look at. And again, it fits our profile. Our model works well in those type of markets, and we just think there's great opportunity there.
Sure. Well, I know you made a big push into Michigan. Are you seeing a strong recovery there in the manufacturing sectors?
Yeah, we're thrilled with where we are in Michigan. And, you know, it's funny, John, we started talking about going into Michigan markets probably 6+ years ago. And I would have investors and analysts look at me cross-eyed saying, you want to go where? But if you think of Michigan, and I don't know how well you know that, well, you're up in Chicago, so if you take west of 75 or west of 23, pick your poison, it looks a lot like Indiana. It's a vibrant manufacturing-based economy. Yes, there's an auto dependency, but not near to the point where if you get east of those markets. So we are very, very excited about where we are in Michigan. And I'll tell you the other thing we have found up there is the quality of the individual employees in the banks that we're partnering with is just very high. Most of them are descendants of one of the larger banks that have either vacated or changed their strategy in Michigan, and they've got big bank experience with small bank hearts.
Very well said. The FDIC pipeline, is that slowing down, or do you think there's still opportunities there on failed banks?
Obviously, did you say FDIC pipeline?
Correct.
Yeah. We're just not seeing them. In fact, I can't tell you the last time I've gotten any notification from an FDIC deal even going to the deal room. So I think it's slowed down significantly. And there's a few, at least in our markets, there's only a few banks that have either capital stress or Texas ratios that would tell you that they could potentially be. And I think the FDIC is appropriately trying to do all they can to work it out.
Do you see opportunities to buy troubled banks outside of the FDIC, or is it still too difficult?
We're just not seeing that many banks. Again, we're blessed to be in, Indiana, Michigan, Kentucky, where the economy is pretty good, particularly here in Indiana. We just announced a couple $2 billion excess reserves in our state yesterday. We're just not seeing banks that are even in kind of trouble. Most of them are earning their way back. I think, obviously the landscape's difficult with the rate environment where it is and the compliance issues, and that's really why people tend to talk to us now is that, they feel those pains versus in the traditional failed bank issues.
Are you seeing any opportunity with 363 sales?
You see them occasionally, but I got Bob Jones' perspective. I think some of the noise around the 363s of late, I just think everybody's going to be a little more cautious.
When you say the noise?
Well, you look at what Sandler's going through, I can't remember that, the last one that went 363, they had issues getting through the court, and I don't know. I just think there's better ways to find opportunities that maybe don't give as much, cause as much gray hair, let's put it that way.
So obviously still one of the sticking points in M&A is the marks on the acquired portfolios. Are you seeing less discounts on the acquired portolios than perhaps 2 years ago?
Absolutely. In fact, using Tower as an example, the mark that, the original mark we talked about at Tower was, around 10-ish. The mark that we end up putting them on our books was much less than that. So you're seeing through the healthy economy and the banks that, if you look at United and you look at LSB, Lafayette Savings Bank, those marks were well below even where we were a year or 18 months ago. So I think, again, the healthy economy kind of, rising tides rises all boats.
Was it 5%, 10%, or can you disclose that?
Closer to 5. I mean, we're moving down into, kind of, I would say a more normal banking environment in terms of credit. And I think the bigger issue in credit now is to go forward look where, because of the competitive environment and because of the rate structure, the rate environment, you're starting to see some banks stretch on structure again, which is, it's not been that long ago that we were in a crisis.
Yeah. So I'm a community bank in one of Old National's target areas. You've expressed interest in buying it. Why should I sell to you? What benefits are there to selling to an Old National?
Well, I'll go to the financial benefit is that, we're a very liquid stock. We're trading, 500,000 to 600,000 shares a day. We've got a good dividend yield. We're a 180-year-old bank with strong financial performance of late. that's one end. I think why we end up getting partners that we do is the word I use. We treat banks that we're looking to work with as partners. We never use the word acquisition. We never say we bought you. You're welcoming somebody into your family. Banks and people aren't chattel. You can't buy them. So, and we treat people very well. And we actually focus more on treating the folks that leave than the folks that stay as well, if not better, because they become our best billboards in the communities we're in. And the other side is we focus a lot on culture. What I learned in my 25 plus years at Key was the value of culture, and that bank mergers are really best done when you focus on culture, because I can merge systems and balance sheets, but getting a cultural mix is difficult. And again, if you go back in Key's history, the Key Society merger of equals was slower because the cultures were so different.
And what I've noticed is, and I don't know if that was a phenomenon with any of your particular deals, but in some cases the approval process for a bank merger takes far longer than what people had initially projected. How do you manage that in the meantime? And it does put a lot of those employees and key stakeholders in limbo while.
Yeah, again, another great perceptive question. So I think what you have to do is be honest. And, from day one, we're going to say that it is almost impossible to predict the timeline of getting approvals. Now, saying that, I would tell you that both the OCC and the Federal Reserve are very, very responsive. They're great at communicating, but they're appropriately dotting the I's and crossing the T's, particularly on the Fed side, where you've got some new governors and you've got, Congress looking at the Fed and, through very bright lights. So, again, back to what you communicate up front that this is a target. We're not sure. We do things like weekly emails. We communicate, here's the process, here's where we are, here's what's going on, and you just be honest with people. And you get out very quickly, and those people you want to retain, you make sure that you either do retention bonuses or they know what you want to do, and it's I think it's just again, it's kind of that partnership mentality versus acquisition mentality. Is much like my wife would like me to be more of, be open, honest, and communicative.
Sure. A hot topic recently has been the subject of branches. There was a study done by Lyons-Bernstein that said that a lot of the super regional banks could cut as many as 50% of their branches. They cited that since the 90s, average branch visits have effectively free-falled from low 20s per year to less than 5, yet bank branches in aggregate have only dropped by, I think, 3% since the 90s. What are your thoughts on the future of branches?
Well, again, by virtue of gray hair and 35 years, we've been talking about the demise of paper and the branches for a long time. We are beginning to actually see a lot of that behavior changes. So we have closed, over 100 branches in the last 3 years in our franchise. And, some of that's through acquisitions and, we have the Integra transaction, but we are actually seeing clients' behavior change. So, the chances of us building many de novo branches will be, not significant. Well, in some markets we might build some. We were constantly looking at consolidation. So I think you're moving to an area where you're going to have less branches. It also, John speaks to the point, is that there's a capacity. The United States as a banking industry, has got an overcapacity issue, which is, again, while I think the M&A markets, particularly in the mid-cap space, are going to be vibrant for some time.
Sure. Switching over to the regulatory environment. So is your bank still treated as a community bank by the regulators? How are you? You're in this sort of unique size where...
Yeah, we're in what they call our primary regulator is the OCC. We've historically been at the low end of the mid-cap banks, so we were treated like, Huntington, for instance, is in our mid-cap bank space. And, Steve's bank's a lot larger than we are, 5 times our size. So, again, credit to the regulator, OCC, as they've treated us as if we were bigger than we were. So we haven't seen a lot of shift in, again, I'm not sucking up to my regulators, but they've done a good job of kind of telling us where we had to go on the highway to once you get across that. So it's been, we haven't seen a lot of change, again, because we were kind of a smaller institution in a large group, and now we're kind of a little bit bigger, smaller institution in a large group.
Right. So the expectation was that you were going to be crossing that threshold, and
yeah, I think that was part of it. And part of it is they reorganized. We were kind of a tweener, and they tweened us up to the bigger banks rather than the smaller banks.
Gotcha.
So it worked out well.
Do you think excessive regulation has restricted access to credit?
I don't think so, because no, I would say that I don't see a lot of pressure, inordinate pressure or unusual pressure on the credit side. I think the regulators are appropriately concerned around structure and other issues. Where you're seeing a lot of new pressures or inordinate pressure is on the compliance side more so than anything else. That's a whole new ballgame for banking, is BSA, AML, and all the areas that come under compliance.
Sure. Yeah, it seems like the past month you've seen that some of the fines, the numbers have been staggering. A couple banks admitted to criminal charges. So it sounds like the compliance issue is first and foremost.
Yeah.
What impact will Basel have on your bank?
Not significantly that we can tell yet. I think we're all still waiting for a little bit of clarity, but we've got a bit of a reprieve, and we're so well capitalized, we just don't think it's going to have a significant impact on us.
Sure. Any thoughts on the expected loss model that is in some level of draft format at this point?
Well, yeah, we're running parallel today. Expected loss. I actually am a big fan of the expected loss. I think that the old days of banking, you used to reserve in the good times and release your reserves in the bad times, or use your reserves. And I think expected losses will allow us to get closer to being able to appropriately reserve. And I think the challenge with the current model is, for us, for instance, you look back on a 6 or an 8 quarter rolling average in coming through a crisis, it's just hard to appropriately, manage that reserve, and manage is a bad word. But I think expected losses, while it's going to be new, I think it's going to be a much more clarity and much better for investors and for all parties concerned.
So why not go to mark-to-market then?
Well, that'd be a perfect world, wouldn't it? Yeah.
It seems the biggest complaint I'm hearing about the expected loss as it relates to loan origination is that it will discourage banks from doing long-term loans, because if you're projecting the loss over the life of the loan, the longer the term is.
In the same case, I can look backwards and tell you the same thing. I think you nailed it. I mean, in a perfect world, you go to mark-to-market on your assets, and pray to God they don't go mark-to-market on your liabilities.
Sure. Dodd-Frank, it's been 4 years, 3 years since it first came out.
Closer to 4, yeah.
As it affects your bank, I mean, how far along are we? Is it?
Yeah, we're probably, I'd say 65 to 70%. We've got a graphic, and actually Kathy can send you we have a JPEG of it. a year and a half ago, I asked our head of compliance to estimate how much paperwork he had been dealing with in Dodd-Frank. And at the time, Tony Ellsworth is our head of compliance. He's 5'8", and he had about 4'6" of paper. We did that again at the end of 2013, and it's now about 6 foot of paper that he's dealing with. And again, the poor guy's 5'8". So graphically, if you can imagine dealing with 6 foot of paper, knowing you still got about 30% more to come, all of it well-intended and probably taken as individual acts and very appropriate. As an aggregate, it requires a lot more manpower. It costs us more, and you know, it's a lot to deal with. And I think again, it's one of the reasons you're going to see more consolidation in the industry.
Sure. So do you think the regulatory pendulum has swung in the direction yet?
No, I think the pendulum is still swinging towards the regulators, and I don't see that changing anytime in the immediate future. I think that, you know, I don't know if you get Richard Fisher's remarks out of the Dallas Fed, but he gave a great speech today in USC that talked about, you know, it's a challenging environment for banks, and you're already seeing banks taking structural risks because they're looking for earnings in a low-rate environment. So as you think about that as a precursor to what we do, then I just, you know, I think until we as an industry maybe learn from our history a little better, I think you're going to see the pendulum continues. And there's so much public pressure, John. I mean, you can't turn on the news and see somebody complaining about banks and bankers. I mean, this morning I watching CNBC and Gretchen Morgenstern was on, and yesterday I turned on and CBS News had a lady saying, why aren't the bankers in jail yet? And we're still not in favor, and I think as long as you have congressional and political pressure, we're going to have regulatory challenges.
Yeah, the other problem, I think, is you rarely get in trouble if you're doing what everybody else is doing. And a lot of what we're seeing on the C&I lending side is, you know, kind of a race to the bottom with respect to pricing and covenants and terms.
Deja vu all over again.
Yeah, I mean, it's very hard to get in trouble in this industry if you're following the herd. It seems like when you're the one far out there, you get slapped. Yeah. But so long as you're doing with the well-respected folks are doing in your market, you're fine.
So that's a great observation. So you get in trouble if you go too far one direction, which is you become more taking more risk. On the other hand, you get in trouble with investors if you go too far the other way, which is you don't take risks. So it's you gotta thread the needle every so often.
Yeah. Talk a little bit about the C&I market, so or loan pricing in general. I mean, you did kind of allude to that earlier. That
yeah, I did.
It's awfully competitive out there.
Yeah, we see a lot of that in Indianapolis. Again, it's such a competitive market. You know, we see pricing in particular. We're seeing banks go long and trying to lock in some rates, but you know, I would tell you in the mid-sized markets, it's very competitive, but it's not stupid competitive. But I will tell you that, John, we've seen through the first quarter, you know, our pipeline held up very well. Second quarter pipelines held up well. We've had good activity. So I think, again, a good indication of the strength of the economies in our markets. And, you know, now's the times where you have to be very careful at, you know, making sure you realize banking is about managing risk.
Sure. There was a professor at I think it was University of San Diego who did a research piece on the big banks, and he basically concluded after looking at Wells Fargo, which most people agree is probably the simplest of the largest banks,
yep.
And he simply concluded that the large banks were unknowable, and things have actually gotten worse in terms of disclosures since the financial crisis. Any thoughts on that? Or a lot of talk about breaking up the large banks. Any thoughts on whether the largest banks are really manageable?
So, too big to fail. I think they're very complex. I think it's too big to fail, and it may be too big to break up, quite frankly, because you become so integrated that it'd be hard to do. And again, while we came through the crisis, and yes, there were things like TARP and others, the reality is, we as an industry, with some assistance from Congress, solved a lot of our own problems. And I think the one thing that people lost sight of is that through the FDIC process, through just consolidation and acquisition, a lot of times we can take care of our own issues. I think what we failed to do during the crisis is we did not do a good job of messaging our challenges, if that's the right way to say it.
Sure.
We got a little arrogant.
My understanding is you did one acquisition, the Integra acquisition, where there was a loss share?
Yes.
Okay. How is the loss share structure being? I know those agreements expire.
It's fine. Yeah. The biggest challenge you have is from a reporting standpoint because, one, you've obviously got a pool of assets that show as distressed assets, but you've got an 80% guarantee from the FDIC. And then the other challenge is you've got the amortization of the intangibles that come with that. And that's just a tough reporting issue, but I think most investors are getting used to it. But for us, it was a strategic play more than a financial play. Clearly had significant financial benefit, but we found the FDIC to be very, very good to deal with.
Sure. And the proverbial question that every CEO is asked, what keeps you up at night?
A couple things. One is people. You worry about, the things like happened in Fort Wayne. That to me is a terrible reflection of my leadership. Regulators, to a degree, quite frankly, stock price. What keeps me probably more, people first, and then I worry about my fiduciary responsibility to my shareholders constantly, and I take that very seriously, and I'm reminded by my board that my job is to control the performance, and the market will do what it can, but I've got a lot of people whose lives depend upon that stock price, and I take that very personally.
Anything else you wanted to add?
I think you're good. You did a great job, actually. Thank you for the time you put into it.
Thank you. No, this has been great, Bob. I appreciate your honesty, your forthrightness, and your insight on the industry.